just going to talk a little bit about the yield curve because this is a topic that we've been hearing in the news, particularly in the context of recession. Just want to talk about what the yield curve is and what it has to do with the prospects of entering a recession. So the yield curve is it's essentially it's a graph that shows the relationship between bond yields and their maturities. So essentially, if the yield of a bond is the return annually that bond is expected to produce, the income return. And generally speaking, a normal yield curve will have the lower returns at the shorter end of the curve. So, the 1 month, the 1 year, the 3 year, and then the yields will get larger as the maturity term lengthens. So you go to 5 years, 10 years. So the yield curve really looks like this at a normalized basis most of the time. It's an upward sloping curve. And the reason why people generally want to get more of a return from longer term bonds is because they want to be rewarded for the inflation risk, one of the biggest risks of a bond. So if you're buying like a 1 month or a 3 month or a 1 year bond, you generally have a better assessment or feeling of what inflation is going to be over that period. And inflation is a direct loss to a bond investor because you don't get compensation for that from most bonds. But if you're extending that out, if you're buying a 10-year bond, there's a lot of uncertainty with respect to what inflation is going to be over the next 10 years, 20 years. So people generally want to have that premium, that inflation premium on their bond. And that's what a normal yield curve looks like. But more recently, we've entered a phase that is called an inverted yield curve. An inverted yield curve is essentially where you have the opposite, where the shorter term bond yields are higher than the longer term bond yields. And what a lot of history, what a lot of people are saying is that the inverted yield curve is often seen as an indicator of an impending recession, that it actually, and some people are saying that it actually predicts a recession. So this is essentially what the yield curve looks like currently. And this is an inverted yield curve. So if you look, the 6 month yield, so these are for US Treasuries, 6 month yield is about 4.8% compared to the 30-year yield, which is about 3.65%, say, right? So you're actually getting a premium on the short term bond relative to the long term bond. And there are a lot of discussions in terms of like what this means. But ultimately, what you're going to see a lot in the media is that the inverted yield curve almost always, or always in recent history, is something that happens shortly before a recession. So some people will say, well, the inverted yield curve is a sign that we are entering into recession, or that there's going to be a recession, say in the next 6 months or a year. So I figured, why not just take a look at what history has shown us? I went to the Fed's website, Federal Reserve Bank of St. Louis. So what this chart shows is this goes back the full history that they provide to about 1975, and the chart shows the spread between the 10-year Treasury and the 2-year Treasury. So this is commonly used to determine whether or not the yield curve is inverted. And anytime the spread drops below zero, that means that the 10-year is trading at a lower yield than the 2-year, right? So on this chart, these shaded areas in the time series, these are areas where we entered into recession. So there's actually 2 recessions in the early 80s, one right about 1980, one just a couple years later. There's another recession in the early 90s, one in the early 2000s, about 2002, I think it was. Then, of course, there was the Great Financial Recession in 2009. And then there was a very short-lived recession, if you can even call it that. I don't know if it was officially called as a recession, but during the pandemic, when things originally locked down in 2020. And of course, anytime this line drops below the zero, the line chart drops below the zero, we have an inverted yield curve. So if we look here, we can see that at least going back to the mid 70s, this relationship does seem to hold, because every time we see a recession over this period of time, the yield curve was inverted. So that's really interesting. Now, if we go right to the far right of this graph, we can see that not only are we in an inverted yield curve scenario right now, but the yield curve is more inverted now currently that it's been since the 1980s. So in the last 4 recessions, if you include the pandemic, um, the spread between the 10-year and the 2-year has not been this negative. Now it's really hard to see, but before the 2020 recession, so to speak, the pandemic lockdown, about 6 months beforehand, there was actually a slight inversion in the yield curve, but it's very so slight, it barely even shows up on the graph. And that's very interesting because one would think, well, how could you predict? How could anybody predict? I mean, this would have been in 2019. This was, maybe the early news about the pandemic had just kind of come out. So how would people have predicted? Well, I'll leave that for the conspiracy theorists. Give them some candy there. But like certainly, it does seem that the yield curve did drop slightly or touch that
Brennan.
zero line. And then we did have a recession 6 months later that you would think officially nobody should have been able to call that recession because it was due to a pandemic, but that was very short-lived. So it's very interesting here. One thing I will note is that the longest recession by duration, by time over this period was actually the Great Financial Recession. That actually started, I believe, 2008. But the yield curve, although it was inverted about 6 months to 9 months before the recession started, that was the lowest level of inversion. So the line was closest to zero. So the yield curve was more inverted in the 2 recessions preceding that, even though those recessions were shorter. So one thing we can say is that the degree to which the yield curve is inverted does not predict the duration of the recession. And from the research that I've read, it doesn't really predict the severity of it as well. But it does seem that there is a relationship here. But I wouldn't get too excited for a couple of reasons. So one is that we don't really have a lot of data to work off of. As I said, this data goes back to 1975. I'm going to put the pandemic aside because that's, a really, really a black swan event. We really only have 4, maybe 5 recessionary periods over that period of time. I mean, the 80s as well was a little, it was a bit of a different scenario, I so to speak, relative to the other recessions. You basically had 2 recessions within a couple year period. You can call that one recession, I suppose. That's really unusual. That typically doesn't happen. So in terms of conventional recessions, you're looking at 3. So there's not a lot of data points to really judge this off of. Another thing that I'm going to point out is that, somebody might look at this and they might say, well, the inversion of the yield curve shows to predict a recession. I would not assume that in any way, case, or in any form. It does not necessarily predict the recession. It may actually be a confounding variable, which means the thing that causes the recession also causes the yield curve inversion, right? Like the 2 things are happening more or less kind of at the same time, even though the yield curve inversion leads the actual official recession. There are likely still signs that the recession is coming while the yield curve is inverting. And if you think about what happens, like what causes a recession, what happens during a recession, well, typically the cause of most recessions historically is that the economy overheats. If you look at the economic textbook 101, the economy overheats, inflation gets high. So what happens? The central banks tighten their monetary policy, meaning that they increase short-term interest rates in order to get inflation under control. And this is essentially what causes the recession. And this usually happens, about 6 to 9 months or so before the recession is officially called. So likely what is happening here as well is that the inversion in the yield curve is being caused by the increase in short-term interest rates, which is already a sign that the recession is essentially coming. So that is, in one way you can look at that as somewhat of a leading indicator, but it's not that the inverted yield curve is causing the recession so much that, the same thing that's causing the recession is causing the inverted yield curve. And why this matters is because the only thing as an investor you should be concerned about is, can I actually use this to make an investment decision? And I would say, probably not. And the reason for that is that, most of the time, the information that a recession is coming is already priced into the market before the official numbers are out. And that's the same case that we're facing right now. Officially, we're not in recession by the definition of recession or the official calls. But the markets have already contracted. They've been contracting for almost a year now. And, that information that a recession is coming sometime in 2023 is at least in part already priced into the market. So you can't just look at by the time the yield curve starts to invert, I think that a lot of that is already priced in. Another thing is that just saying that a recession is coming doesn't really give you a lot of information, because it doesn't tell you, is this going to be a deep and long recession, or is this going to be a shallow and short recession? If it's a shallow and short recession, markets likely start to recover by the time we officially call it a recession. If it's deep and long, certainly there's a lot more downside as more negative news comes out. But if you're going to try and use the inverted yield curve to make investment decisions and time the market, I really think you're still flying blind, because certainly the data does not show us that the yield curve predicts the duration of a recession or the depth of it. And that's really what's important as to whether or not, I would agree that we will enter a recession likely sometime over the next year, because that's the purpose of what the central banks are doing. They're trying to destimulate the economy, pull back on the reins of an overheated economy and labor market, and typically that causes a recession. But if it's a short and shallow recession, it may not even feel like one. And by the time it hits, people may already be looking at the light of the end for the light at the end of the tunnel, and the markets can already start moving up in advance of that. So trying to time the market using this is not a great strategy. As always, it really comes down to not trying to time what's going to do well over the next 6 to 12 months, but rather what are the companies that are solving the important problems that need to be solved in society over the next 5+ years. That's the way we would invest. But it's interesting, and it does seem that that there is a relationship here. And once again, the yield curve today is far more inverted than we've seen since the 1980s. Now, I will give you another assessment on why it's so inverted right now. We've had, with the exception of the 1980s, we've had a huge increase in inflation over the last year. So if you're buying a 1-year bond, like right now, I don't know what GICs are paying, but I think it's around, say,
3%.
Sorry,
it's 3 for just straight like retail GICs.
I thought it was more 3%. Than that. I thought it was like 4 or 5%, because we looked
that's the retail rate. I was actually looking at earlier today for some siblings.
Oh, okay. So you're regardless, you're getting a much nicer, like on the 1 year, you're getting a much nicer return than you've gotten in the past, like whether it's 3-4%. But if you're expecting it's going to take time for the central banks to tame this inflation, then you're still at a negative return over the next year. Inflation only has to be 3-4%, and you're already in the negatives, right? But if you're looking 10 years out and you're like, well, central banks are likely going to tame inflation over the next 12 to 18 months, and then I have another 8.5 years of bond returns, your average inflation expectation over 10 years is likely lower than what it is over 1 year. So in that case, you would expect less of an inflation premium on your long-term bond. So that's a rationale as to why the inverted yield curve is so inverted at this point in time. But once again, I wouldn't spend too much time on trying to use this to make predictions on where the market's going to go. Most of this is already priced in right now.
Yeah, that's St. Louis Fed chart that you included. I think that it's very good for people to look at, but like a good visual representation of the yield curve. There's a lot of videos on YouTube. Like, for example, I'll just quickly share my screen, just so like people can kind of see what the yield curve is doing over time. So you can actually play it out and it shows, what the yield curve is doing over time. There's a lot of these kind of visual representations on YouTube, but I just think that it helps to kind of get an idea or give you a little bit more of a visual representation of, what the yield curve's actually looking at. If that St. Louis Fed chart does confuse you a little bit, even though, it makes perfect sense.
Obviously, you're confused.
It confuses by my chart. Brennan.
Yeah.
So.
I was not, but I just know that when I've been studying for the CFA and whatnot, it has kind of helped me to kind of see a visual representation over time, especially when you see the steepening or the flattening of the curve, because generally coming out of a recession, I believe usually the curve really steepens a lot. So, you can kind of see that visually with, kind of these charts that people have made on YouTube. Anyways.
That's a lot of curvy talk.
Mm-hmm.
So let's go to, do we want to, I was going to not.
You should, if you find one, Brennan, that you think is really good, why don't you tweet it out or put it in a post?
Yeah, we can do that. Yeah. There's a good one, like the one that I was just showing, that goes from like 1954 all the way to 2019. So you can kind of see that whole period and all of the recessions and what the
we could tweet that out if anybody's interested in it, or send it out when we send out the the email for the podcast to all the subscribers, so we could send that out.